In the earlier episode, we talked of the many investment options where you can invest money towards your goals. We talked of bank FDs, NBFC FDs, national savings certificates, etc. What about the stock markets? Today, all around you, you see folks claiming that they've made money from the stock market. The social media is full of folks claiming that they invested in so and so paint stock or cigarette stock 10 years ago, and today it is worth lakhs or sometimes even crores. They don't tell you about the stocks where they invested 10k and they lost their shirt. The main thing for investors to understand before investing in the stock market is that this is an asset that can multiply your money or decimate it. Investing in the stock market is not for everyone. To actually be successful at it, you need 4 attributes. Usually when I ask a person whether they can take risk, you get a vociferous yes. That could be because the person is not thinking of risk in the correct terms. Textbooks offer many methods to assess risk, but the most realistic one is to consider how much money you are willing to lose. So the stock market is a place where you can lose a lot of money in a single year. Investors who have been invested in the market from 2008 will tell you that they lost 50% in a single year in 2008. In 2020 during COVID, you had a couple of months where the market fell 40%. There are investors who used to invest in the previous bull market who lost 80 to 90% on some of their stock bet. In post office schemes or FDs, you may make a lower or a higher return, but you will never lose your principal. But losing your principal or the capital that you put to work is quite a common occurrence in the stock markets. This is why to invest in the stock market, the first thing you need is a healthy risk appetite. You should also bet only that amount of money on stocks where you are prepared to lose 40 to 50% in the worst case scenario. So how do some folks become very rich with stocks if stock markets have this habit of crashing 40 to 50% every few years? They do it by simply hanging on through these declines. If you look at the 2008 crash, people who invested just the year before and waited till 2014, they were able to break even on their returns and then make money. So the important thing in the stock market is your ability to hold on to your stocks for a long period. Now some people will tell you that you can make money in stocks within 3 years or 5 years, but from the history of Indian stock markets, it actually takes about 7 years when there is a big crash for you to recoup your capital and get to making reasonable returns. So the holding period of 7 years or more is very important to invest in stocks. In the short term, stock prices move in cycles, but in the long run, actually they track the earnings of the companies that they represent. In a growing market like India, where the economy is growing, if you look at the long-term graph of the Sensex or the Nifty, the big crashes that I mentioned like 2008 or 2020 will look like mere blips in the long upward graph that you see. This is why it is important if you invest in the stock market to be able to treat the crashes as blips and to hang on patiently through these phases so that you can see the big returns in the long run. The stock price of any company actually tracks the underlying earnings. So in order to predict whether a certain stock can really deliver returns over the next 7 years or 10 years, you need to be able to gauge if the business can really deliver growth and profits over that long time frame. This requires you to not just assess the prospects of the industry over the long run, but also to gauge whether the company that you are choosing can actually manage to grow its revenues and maintain profitability over a long period of say 7 or 10 years. The examples you see of banks, paint companies, etc., which have given 10x or 15x returns in the last decade, actually are loaded with survivorship bias. What is survivorship bias? Basically, you are looking at only the stocks that have survived the ups and downs of the market over this period, ignoring the many dozens of stocks which have also turned turtle in this period. So for you to know which are the stocks over the next 10 years which can deliver high returns or which can actually multiply your money, you do need skills of reading balance sheets, the ability to know good managements from bad ones, the ability to know how a sector can grow over the long term. Many folks think of stock market investing as a kind of a hobby or a part-time endeavor, and they can just do it and juggle it with their full-time jobs. But that is quite difficult because, as I explained, to actually succeed in stock market investing, you need to know your company or business like the back of your hand. To do that, you will have to put in a lot of work into analyzing companies, sectors, networking with other investors who are also into investing, and also tracking the company's numbers closely. All of this requires time and energy. Look at any successful investor or even trader in the stock markets, and you will see them fully immersed into the world of stocks, markets, and companies 24/7. This kind of passion is required to succeed at investing directly in the stock markets. If you want to skip all this and if you still want to make money from stocks, there is a shortcut available to you, and that is mutual funds. In our next episode, we will discuss what are the options available with mutual funds and how you can take advantage of them.